Have you ever had a drawdown in your trading account? Have you ever had multiple losses in a row? Have you ever experienced a crisis of faith in your trading system? If so, then this video is for you. Hello everyone, my name is Michael Lamott. I'm the founder of ChartYourTrade.com, and our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And part of the way that we do that is by sharing all of my experience. Some of them good, some of them not so good. Some of them are just terrible, but the key is sharing all the experiences, sharing all the lessons learned, and how those lessons have ultimately translated into what has become very successful. In today's video, I'm going to share with you a string of losses that we had last year, right at the beginning of January. So the first two videos that we shared were two wins. They were great. But then from there, the next 4 out of 5 trades were losses. And I want to share with you what I learned and just my experiences dealing with that, and how pushing through that ultimately helped lead to success. So in your own trading, especially when you're following somebody else's trades, that's a professional, the last thing that you want to do is experience losses. And especially when you in the moment, or even after the moment, you look at and you kind of think, well, I would have done this or I would have done that, but I'm following along. It's very difficult, both psychologically and emotionally, to deal with that. We had 4 out of 5 losses in January. The stocks that we're going to take a look at today are Deere, ticker symbol DE, ticker symbol RS, ticker symbol ICE, IYT, and XLF. That's the financial ETF. The other ones, honestly, I don't even remember the names of the companies. The names of the actual companies tend to be a lot less important than actually trading the price action. Both Adam and I believe that it's more about the story that the market tells versus the story that you read in the news or in the media or wherever. And so the story that the market tells is the one that we're ultimately going to follow. But I want to share these trades with you, and just so that way you could see too that you need to be able to push through these things. And if you're just starting out, and if you're just starting out with a brand new service, it's tough to see the light at the end of the tunnel. And it's funny, actually, one of the reasons why when we went back and we reevaluated, we used to give 1-month trials to the advanced stock report service, and a lot of people would sign up just to get the model portfolio and kind of be guided on what to buy, what to sell, when to buy, when to sell. And in reviewing the performance, if you're somebody that just comes in for a month just to follow this thing, you could easily just see a whole bunch of losses and then be like, well, what the hell is this guy talking about? I didn't sign up for this to have a string of losses. Cancel, right? And could we blame you? I mean, who the hell signs up for the stock market to lose, right? It's part of the process, and you need to see the full process. And so that's why we're doing this new promotion of 3 months for $27. So that way you're able to see 3 months worth of action, be able to have a lot more experiences interacting with both Adam and myself. This isn't meant to be an infomercial, but just to kind of give the rationale. And you get to see and experience a whole lot more. And if you're going to try any kind of trading methodology, whether it's with us, whether it's on your own, whether you're going to somebody else, 1 month is really not enough time to dig into any of it. And so right after, it's funny, right after these 5 trades that were, 4 of them were losers. One of them was, I think we only gained about 0.5% or something. You'll see when we go through the actual trades. But the trades right after those end up being Alibaba, which we made about 70% on, and Adobe, which we're still holding from last year, and I think we're up about 90% on that one. Had we just stopped after those short strings of losses, would have missed out. And that's part of the reason why you need to have a longer term focus and be able to push through some of the pain that the market deals. So let's dig in and look at what some of these pains were and what some of these trades were, and how even looking back, it's still kind of painful to look at. Let's dive in. Okay, the first trade up is Deere, ticker symbol DE. Now, we're looking at this, and we entered right here January 4th at $104.93 with an initial stop at $99.97 right over here, right? And you can already see over here that we sold almost immediately because, well, we ended up raising our stop. We raised our stop up to break even, and we got stopped out in a hurry because that morning it actually gapped down and ended up reversing higher. In the model portfolio, we use hard stops, and I also like to use hard stops as well, because the idea is that we're not always going to be in front of a computer to execute orders. So if they are just resting with our broker and we just say, hey, look, sell if it gets to this price or buy if it gets to that price, then we could just give them the order and step away and not have to worry about it during the day. Now, and there's advantages and drawbacks to it too. One of the drawbacks is that, yeah, you could be shaken out like this, where you get stopped out at the low because it crossed price, and then price can reverse higher intraday and end up being a buy signal. The benefit, however, is that, yeah, it could have kept on falling, right? Well, we never know what is going to happen. We only know what's happening right now in the moment. And it allows us to be able to have how many hours back in the day to do other things and not have to be glued to the market. For me personally, I would much rather not be glued to the market all day long, and that's one of the benefits of having resting orders with a broker. Now, in this case, super frustrating, right? Especially when you see it hit your stop, reverse higher, and now you're out of the trade. Okay, that's a little annoying. It doesn't get to be really annoying and heartbreaking until you start to see what happens later on, right? So exited within a couple of days, ran up, right? Yeah, you have a little shakeout below the 50-day over here. Okay, no big deal. So up here, right? Like, well, so what would we have gained if we stuck around? That is a 26% run that it had from the time that we bought, right? So looking back in the rearview mirror, yeah, that really sucks, right? It's real easy to they say that hindsight is always 20/20, and if we're looking at this right here and looking back like, oh man, well, we should have stayed. Well, should you have? Did you know that it was going to do that? The only thing that we know is what's right in front of us. So was the stop raised a little bit prematurely? Why was the stop raised at that point? Part of the reason had to do with the overall health of the market and trying to protect other positions and kind of seeing like what other leading stocks are doing at the time and seeing a lot of shakeouts, and there's so many elements to risk management. It's not just this one position, and it's not just the health of the market. It's also the psychology. It's also managing risk as well. And you want to take a holistic approach to how you're going to manage a portfolio. And when you're thinking more long-term and not just trying to win the day, sometimes stuff like this happens. And then when you look at it this way, yeah, you get this dipsy doodle down here and you get that shakeout. You never got back into this, but then you have this monstrous run. It's like, well, what the hell did I sign up for, right? But if we did get in back here, that's a 45% run, and just buying it back here and falling asleep would have produced a 60% run. Instead, what happened? Well, we bought at 104.93 and we raised our stop to break even, and because of that gap down, we sold at 104.14, taking a pretty small loss. Okay, happens, right? Still in January, still sitting on those two larger wins, right? MU and SMH. Let's go to the next trade. Here's our next trade. Ticker symbol is RS, and the company is Reliance Steel and Aluminum Company. All right, so we have this move, right? So just to zoom out a bit, we see that it had this nice big run. This is looking back at 2016, then it corrected, found support, found major support right here, right? Look at that volume and the reversal higher. Then it broke out of that, big volume, still running up, still more volume coming in. Then it starts to correct and pull into the 50-day moving average, right? So, and it's pulling into the 50-day moving average on very light volume. Look at this volume down here, right? And it's doing so, and the price action is pretty controlled, right? It's pulling in, gets support at the 50-day moving average, and we notice, or Adam notices rather, that it has this little descending trend line over here. It has this resistance level over here. So if it breaks above this, so it's breaking above two things, then okay, that's going to trigger the entry point. Solid plan. Solid plans don't always work out. So we ended up entering there at 1895. Support was right down here, right? So it made this support level and it broke out. And if on a breakout, the low should now turn into a support level. This support level goes way back to over here, and we had our stop set at $79.47. Or, yeah. And so if it were to continue to rally, then that's a solid level of support that it should have maintained. Did it maintain it? No. What it did, it reversed on that breakout, and we bought that one on January 5th, ended up selling it for a full loss on January the 19th. All right, so first loss, so more or less break even, very, very small loss. This one is a full loss. We lost the full amount of the trade. So on a $100,000 portfolio that we're risking 1%, this is $1,000 loss. That happens. That happens. The key is that you want your winners to be much larger than your losers, so that way you can have trades like this and have several trades like this and still come out way ahead. So let's zoom out, see what this did. And yeah, it rallied right after there, but then soon after that had this much larger correction. So if we just wanted to have a trade like this and then fall asleep on it, well, would have, instead of having what percentage was that? We lost about 4.5% on that, 4.5–5%. If we just slept on it, turns into a 17% loss. So much easier to come back from a 4.5–5% loss than it is to come back from a 17% loss. Remember, one of the real keys to winning in the stock market is by compounding gains. And if you end up having big losses like this, or what this could have been, then it's far harder to compound your gains. All right, here's the next one. Intercontinental Exchange Inc., ticker symbol ICE. Now, this is another one that we ended up entering on January 5th, and we entered at $57.56. And we entered on this little advanced entry point over here, right? So it broke above it intraday and reversed. And we had support down here. Our initial stop was set up right down here. So if it breaks out and then were to roll over, then yeah, that means that pattern would have failed. So that pattern did not fail. That actually ran up a bit. So that's certainly a good thing. It was getting support at the 50-day moving average over here. When it broke out over here and then it retested the 50 and it had the 100-day moving average kind of creeping up and supporting it, then that was another idea that, okay, it had support at the 50-day and the 100-day was catching up, not too far behind it. So if it were to break out, move a little bit, roll over, you have multiple layers of support working, and you like to see that on any trade. Starts to work, had to deal with a lot of choppiness after that, and then by the time it finally gets over here, right, so we bought at $57.56 on, what day was that again? January 5th. Finally sold it in May 10th to be exact. And we only made about $1.20 on it, $1.19 on that trade, for something that was held for 4 months, right? A little over 4 months, right? So let's pretend that we don't know that move happened right there, right? Let's just say that we saw this and we sold, right? So that kind of makes sense, because you had this run up, you started to see the support develop over here, you raise your stop up to that level, you get that shakeout below the 50-day moving average, and then it starts to fall below the 100-day moving average, where it got support at back here, arguably over here too, and then, okay, fine, exit. Makes complete sense at that point, at least to me. Then, almost immediately, you get that kind of a rebound and rally, and here we are today, right? So, rear view mirror, let's see how good the rear view mirror is. That is about a 30% gain, right? If we just fell asleep on that one, and if we did not raise the stop up to the point where it would have made sense to raise the stop up. But again, well, when you're looking at these things, did we know that we were going to keep on running? Do we have a crystal ball? Do we have the DeLorean that we showed from back into the future in that other video? Well, we don't have any of those things. We can only work with what's in front of us and the different support levels, and sometimes that means getting frustrated as hell seeing stuff like this. And this is a gain, right? So back here in the moment, yeah, it makes sense, can live with it. But in going back and kind of seeing like, oh, well, what happened afterwards, yeah, that's frustrating. And it's being managed by somebody that has all this experience and they should know. Well, they do know, and they know that you need to just trade what's in front of you. And sometimes that means that you're going to miss out on upside. What matters more is not the individual trades. What matters more is the overall performance of the portfolio. And that's part of why it's so important to be able to dig into something for a longer period of time than just a month. A 1 month evaluation isn't enough to really view anything. Solid 3 months, you could really see what's happening and how things are evolving. And yeah, just stopping at trades like this and seeing something like this, just kind of like chopping around, not really doing much, yeah. I could totally see how you'd be discouraged if you didn't know more. And I have the benefit of working with the guy for multiple years at this point and seeing and knowing how things develop. So that's enough on ICE. Let's move on to the next one. Here we're looking at the iShares Transportation Average ETF, ticker symbol IYT. Now, the transportation industry group was really on fire towards the end of 2016. Just look at the volume coming into this big run, and then it starts to consolidate right at around the 50-day moving average. And so pulled back, had this little descending trend line. Great idea to get in right here, right? And hopefully it would continue its move. And it did for a little while, and then it started to consolidate and stopped us out, right? So got in on January the 11th and ended up exiting March 27th when it fell back down, broke support over there, and yeah, it's zooming out. Here we are today. So many stocks, especially at the beginning of January of 2017, just kind of like chopped around and then had some shakeouts, and then yeah, if you just fell asleep and didn't do anything, well, it was an example from earlier. If you fell asleep and did nothing, you would have been worse off. But here's another example where sometimes you fall asleep and you'd have a 20% gain, right? On this trade, well, what did we risk? We risked 2.5%. Right, so if we're able to leverage our positions, there's a whole video that I did on position sizing and how I like to back into the number of shares that I could buy. This one, I was able to leverage more and still only risk 1% of my capital. So on that $100,000 account, risking 1% of capital, $1,000 loss. Right, or if you're trading a $10,000 account, you're looking at a $100 loss. So, well, whatever it is, 1%, it's more about compounding those kind of gains. But, well, the point that I want to get across is that psychologically, it's tough to deal with this when you're just focused on each individual trade versus the aggregate, and knowing that the aggregate takes a much longer time to develop. So in this series, I'm really hoping that you're able to see the psychology of what goes into all this. Let's look at the next trade. We save the best for last. This is not intentional. This is just the way that the market worked. So on January 17th, we ended up buying XLF. XLF is the financial sector ETF. You can see that towards right after the election, gigantic run in 2016, really exploded after there. Started to consolidate right around this this purple moving average. That's a 21-day exponential moving average. Started to catch support right around there. Bought it as it broke out at 23.58. Set the stop at 22.97. Ended up selling it the very next day. This is round tripping a stock. If you have not round tripped a stock or an ETF or whatever it is that you're trading, you have not lived, you have not experienced the market yet, because this is something that happens. Doesn't happen every day, thankfully. Doesn't happen very often, thankfully, but it's something that happens. And yeah, it's extremely frustrating when that happens, because yeah, now you're out that 1% of capital again. And now in January, like the first 5 trades that we just looked at, were 4 out of 5 of them are losers, right? And let's zoom out and see what XLF had did since that point, right? So kind of ran up a bit there to see that immediately after having sold that, or to go back and look at your trades, like, oh, I exited here, check back a week or 2 later, see what it's doing. Yeah, that's extremely frustrating. I'm sure that it's frustrating for you if you sign up to this service. It's frustrating for me because, yeah, it's my money on the line, and I'm following this model portfolio too because I know what it's capable of. But to just see individual trades like that in real time, yeah, super frustrating. I get it. But then, yeah, like it rolls around, it chops around some more, and here we are later on, right? So again, this is how the market screws with you, right? You have a system. You know that the system works. You know that the system works over the long term. You also know that individual trades can end up being frustrating like this. And if you end up giving up too soon, the next trades that we're going to look at next time, and we'll go through these ones a little bit more in detail. Adobe, right? Breaks out. Has this gigantic run, right? And that's when up 65% when we were looking at it back here. Right now, as of today, up about 80%, right? And then Alibaba, right after that, end of January. Look at this move, right? Had we given up after just seeing this, screw it, I don't want to deal with the market anymore, I don't want to deal with this service, let me go try some other methodology, would have missed up on all that other upside that would have paid for every single other loss. Remember, these are only, you're only risking 1% of your trading capital per trade, right? So and you have other trades that make 19, 20 times the amount that you've risked with something like Adobe or like Alibaba. That's what's going to make your year. That's what's going to pay for all those other losses. So you need to get through the crap of dealing with something like this, or this kind of a frustrating move, or this, where you're out the next day. You got to be able to push through those in order to get to those trades that are going to be the bigger winners. So it's knowing your methodology, it's knowing the system, knowing the process, and knowing the pain that you need to go through in order to get through that. So that's the point of this series, right? I want to show you the path that we had to tripling the S&P 500. Was it a clear path? Was it an easy straight line? Were there a lot of turns? We had to go through some crap in order to get to that tripling of the S&P 500. It wasn't easy. And I want you to know what the path looks like so that way you can get there. You don't have to go and pave it yourself. The path is already there. You just need to understand what the path looks like and have the courage to walk along it. If you want to try out the advanced stock report service with that model portfolio, normally it's $97 a month. You could try it out for 3 months for only $27. So for 3 months, you're only paying $27. Use coupon code 3427 when you check out, and you'll have it for 3 months for only $27. And hopefully you'll be able to push through whatever the market throws at you and be able to see the promised land of some of those outstanding trades. Thank you so much for watching. I truly, truly appreciate it. If you have any questions at all, please leave them in the comment section below and I will personally help you. Also, if you like this video, click that little thumbs up button. That's really going to help us out a lot. And also make sure that you subscribe to the channel so that way you're going to get every single update. Thanks again for watching, and I'll see you again in the next video. Take care and have a great day.